Welcome to The Explainer. Today, we're digging into a real head-scratcher for investors. The market is sending out signals that are completely, and I mean completely, at odds with each other. So first things first, let's just mark the calendar. The reason the date matters is because we're at this really strange, really tense moment in the financial world. We've got huge central bank decisions just around the corner, and you can just feel the tension building. You've got optimism and pessimism basically at war with each other, in a way we really haven't seen for a long time. So what is actually going on here? Why does it feel like the economy is flooring the accelerator and slamming on the brakes at the exact same time? Okay, so this right here, this is the heart of the puzzle. Just look at this. Stocks are up. That screams optimism, right? But wait, long-term borrowing costs are also up. The price of oil, a key sign of economic activity, is down, and the market's fear gauge is spiking. These things just are not supposed to happen all at once. It's a total contradiction. All right, let's start peeling back the layers. And the first place you have to look, the most obvious suspect in all this, is the U.S. Federal Reserve. The entire stock market seems to be making a massive bet on one single thing, and it's all going down this week.
I mean, look at this number. The market is basically screaming that a Fed rate cut is a done deal. We're talking an 87% probability. That single hope is pretty much what's propping up stock prices right now.
So what's the Fed thinking? Well, on one hand, they're seeing some good news. Inflation is finally cooling off. Their favorite metric is down to 2.8%. But, and this is a huge but, it looks like that's happening because the actual economy, the one we all live in, is starting to sputter. Consumer spending has flatlined, and that suggests this slowdown could be a lot more serious than the optimists think. And that brings us right to the main event, this bizarre thing that analysts are starting to call the yield paradox. Even though a rate cut is almost in the bag, the 10-year Treasury yield, which affects everything from mortgages to business loans, has been creeping up. So how on earth is that possible? This quote from Kathy Jones just nails it. Basically, the bond market, the so-called smart money, is getting really nervous. They're worried the Fed is declaring victory on inflation way too early. And if they think that, they're going to demand higher interest rates on long-term loans to protect themselves, which totally cancels out what the Fed is trying to do. Okay, so let's zoom out for a second, because this isn't just a U.S. story. The moves being made in Washington are sending some serious ripples and some major risks all across the globe. And what you see is this huge split, this massive policy gap opening up. You've got the U.S. Fed getting ready to ease up. At the same time, the Bank of Japan is hinting it might finally start tightening after decades. And Europe? Well, they're just kind of sitting this one out, watching from the sidelines. Now, this kind of divergence is a recipe for trouble, and it all comes down to something called the yen carry trade. For years, big money has borrowed Japanese yen for next to nothing and invested it where rates are higher. If Japan raises rates just as the U.S. cuts them, that whole trade could unwind violently. We're talking a massive, sudden reversal of capital that could send shockwaves everywhere. And then you have the European Central Bank just choosing to stay out of the fray completely. The fact that they're focused on these long-term projects like a digital euro tells you everything you need to know. They are not jumping into this fight, which just adds another layer of weirdness to the whole situation. All right, time for our last piece of the puzzle. And this one's a biggie because it comes from the physical world, not just a spreadsheet on Wall Street. It's maybe the clearest sign we have that Main Street and Wall Street are living in two different realities right now. And wow, does this chart tell the story? You've got stocks flying high on the hope of cheaper money, while the price of crude oil, the actual lifeblood of the real economy, has been tanking, falling below $60 a barrel. This line says it all, right? A fundamental disconnect. Think about it. You can't have a truly strong, growing economy that's using less energy. It just doesn't add up. The drop in oil is a huge warning sign that the real economy of factories and shipping is slowing way down, no matter how cheerful the stock market is. Okay, so let's put it all together. Let's solve the mystery. What happens when you have all these powerful, contradictory forces pulling in opposite directions at the exact same time? You see, the market isn't irrational, it's just completely deadlocked in this massive tug-of-war. On one side of the rope, you have Team Optimism, cheering for Fed rate cuts. On the other side, you have Team Pessimism, pointing to weak oil prices, weird bond deals, and global chaos. The result? A super volatile market, totally on edge, where neither side can get an advantage. And this stalemate isn't just confusing, it's creating some very real systemic risks. Let's break them down. First, there's monetary risk. The Fed gets it wrong, loses its credibility, and long-term rates spike anyway. Second, policy risk. Japan makes a move, that yen carry trade blows up, and we get a global credit crunch. And third, the simplest and maybe scariest one, economic risk. The real-world data just keeps getting worse and proves the stock market was dead wrong all along. So that's where we stand, heading into this monumental week. And it leaves us with one massive critical question. With the bulls and the bears locked in this epic battle, who's going to flinch first? Will the hope for cheap money win the day? Or will the cold, hard facts from the real economy finally drag this market down? The answer's coming, and it's going to shape everything as we head into the new year.